Okay, so very good morning to the briefing for Monday the 1st of August. Hope you all had a great weekend. Just digesting then some of the news flow from the last couple of days. A look back to last week, some of the current prices and then what to look out for this week. Looking at the charts though this morning, you've had quite a large gap up in European stock futures. A combination of a couple of factors, but first and foremost, the European stress tests. They of course came out at 9 p.m. on Friday. Just taking a bit of a summary of that, because overall the net result was that bigger banks have fared better than expected. So banks have aggregate market risk losses of 98 billion, credit losses of 349 billion, and aggregate operational risk losses of 105 billion in stress tests. The test then overall showed that European banks had a better position and more resilient, although, as to be expected, banks from Italy in particular, as well as Spain, Ireland and Austria fared the worst. But notable banks that fared, or some that fared better, were Deutsche Bank, which actually outperformed Barclays. Looking this morning at how some of those banks are performing, most of them seeing some decent single percentage gains to the upside, but the likes of Monte dei Paschi shares, of course, the weakest of the Italian bunch and have been hit hardest on the last week or two. Their shares are actually up around 10%. That's because shortly after the results came out, the government essentially came out and the bank then accepted a €5 billion recapitalisation plan. So it's kind of the confirmed 11th hour private sector bailout for Paschi, helping lift their shares. And you know, when Italian banks start rising, then generally that does tend to lift the mood, so to speak. So let's have a quick look at these stress test results. We'll just make this a bit bigger. So these are the 11 most stressed banks in Europe, as you can see at the moment. As you just said then, Monte dei Paschi di Siena is the worst. This is in like the scenario, hypothetically, over 3 years, a recession and bond market collapse, so the most adverse scenario possible, and this is how they would react. So below the minimum regulatory requirements is both Paschi and Allied Irish banks. Now, more interesting though was the fact that these guys down here, Deutsche, were at 7.8%, but Barclays were 7.3%. The other more systemic names that you're used to seeing, the sole systemic name in Italy, Unicredit, at 7.1%, but also above the key threshold. So overall, actually, not a bad result from the stress tests. The Italian banks, as I say, to be expected, but one caveat, and we touched upon this a couple times last week, is the methodology. So although sentiment's been somewhat lifted this morning, it is worth again mentioning that the process did not model for a prolonged period of low or negative interest rates or yields, or it didn't model any Brexit type scenarios. So one does have to wonder then how accurate these stress tests can be when two factual events that are happening that are quite unprecedented at the moment, negative interest rates and the Brexit scenario, haven't even been factored into these potential outlooks going forward. So maybe a question mark on that side, but nonetheless, looking at the S&P here, bottom left, we have managed to move above then to all-time fresh highs at 21.77 3/4. Again, you can see here on my chart, this is kind of a July through to 1st of August today, so the last month's performance. And after that big rally that we had post the Brexit sell-off, we petered out and kind of went sideways for the latter stages of July month. But we've managed to just get above that following some of that overnight news. Now, not only did you have the stress test results, you also had some data coming out of China, so worth just taking a look at that. This is the China Caixin Manufacturing PMI. It rose to 50.6, so beat expectations of 48.7. It's the first expansion in this reading since February of 2015, as output rose the most in 2 years, while new orders expanded at the fastest pace in nearly 1.5 years. Looking at that Chinese number here, this is a big jump higher here on the prior month, and again, it's somewhat of a psychological marker, given we've moved back above that key 50 measurement when we look at this type of data. So expansionary manufacturing seen in China for the first time since, as stated there, early 2015. So that's another positive metric that's helping just lift some of the mood this morning to get the week underway. That also led to a generally positive Asia session as well overnight. A quick look then at some of the other things to be aware of. Starting with crude oil, you can see here in the top right of my charts. Now, we talked about this last week, the kind of very quick fall that we had from the sort of $50 level down to this 40, kind of 53, 40, 50 levels lows that we've been seeing more recently. But we've seen a bit of a bounce here. Now, remember last week, you had US output showing an increase for a third consecutive week. You also had a build-up of oil inventories. A number of factors then that have led to this fairly sharp decline seen over the course of mid to late July, running from 46 to close to $40 in pretty quick succession. But we are starting to see a bit of a turn this morning. But one thing I saw on Friday that I thought was worth looking at is the rig count. So this comes out, Baker Hughes rig count, every Friday evening, 6 p.m. And US drillers added oil rigs for a 5th consecutive week. So the total now 374. So looking at the chart here, you can see you've had this absolute collapse at the beginning of 2015. Likewise, through the back end of that year, when you remember oil prices at the time, going into the early part of this year, we were tracking down at the $26, $27 mark. That was when we were at a 7-year low in the operational rig count number. And so that started to take a bit of an uptick here. And that kind of explains then as well some of the increase we've seen of US output of late. So although looking at CLE on a slightly shorter time frame, we've seen a bit of a bounce this morning. Demand side obviously positive. The expansionary manufacturing number out of China is a good signal for demand out of one of the biggest energy consumers on the planet. But overall, tough to see this trend really breaking down at this point in time. The breaking of the trend of the inventory numbers from the DOE, the first build we've had in around 9 or 10 weeks, and US output now on a consistent and consecutive 3-month trend upward, would say then at some point this week it would not be a surprise to certainly see $40 handle tested. And then if that gets broken, it could then open up some fresh downside. Looking at it here, probably 37.50 looks like the next kind of marker in the sand should we move below those levels. Obviously, if oil starts to move lower through 40, this brings into question the Fed, because one of the points that the Fed are looking at is they need inflation back up at target. And if they're on the course of raising interest rates, then certainly they want to see inflation moving to the upside, and oil's only going to be a drag to achieving that goal. Now, over the weekend, did have some comments out of a policymaker. So the vice chair of the Fed, so carries a little bit more weight than your normal members, and should be then closely aligned to the view of Janet Yellen, the chairwoman, has said in an FT article the Fed policymaker cautions over potential rate rise. So suggesting the US central bank should tread cautiously before triggering or pulling the trigger on another interest rate increase, given potential pitfalls at home and abroad. Now, I want to show you this chart here of how the game has changed more recently. So, return of the dove. Bets on a Fed rate hike in 2016 are well below 50%. Now, The Fed's latest communication and their statement said that September is still a viable option, but looking at federal funds rate futures, September is currently around 16 to 17% probability. So very unlikely at this point. Even looking at December, which is this white line you can see on this chart, we're only at 35.7. Now, we had US first reading of Q2 GDP on Friday, and that was pretty abysmal. It came in at 1.2%. I think the consensus estimate was 2.6. So a lot weaker than expected, and that has prompted a number of economists on the street to revise down their GDP forecasts, and therefore slower growth. If oil starts moving lower, lower inflation is severely going to hamper the Fed's ability to hike interest rates. And let's not forget that comes also amid political uncertainty emanating from the Trump-Clinton race, culminating in the actual vote at the beginning of November in the presidential election. So again, Fed hikes looking increasingly uncertain in this environment, and if anything, that should support then this underlying trend that we've had of higher equities, or certainly the S&P tracking up at around these all-time highs that we've printed today specifically. A quick look elsewhere. One of the other big things we're looking out for this week is this chap. The unreliable boyfriend, as he's known in the market, because he promises everything and delivers nothing. Will he let you down again is yet to be seen, but Mark Carney has a big meeting to deliver on August 4th, this Thursday. They delayed the last interest rate hike, cut, and now it's in what form or shape does the easing package from the Bank of England come in on Thursday. Now, the market is very much expecting a rate cut, but you also get the quarterly inflation report. Now, the reason why this is important is this is their updated projections, like the dot plot projections from the Fed, so to speak. And you also get Carney then hosting a press conference afterwards where he'll look to soothe the kind of communication of their outlook over the 2-year horizon. Question mark then is, on the outlook, how drastically does the Bank of England downgrade its growth forecast following the Brexit? Now, this FT article is suggesting that growth forecasts are expected to be cut to or close to and perhaps below zero. I'd say that that's pretty much in fitting odds with most expectations. Most investment banks and economists are foreseeing a potential flat to negative growth at the end of this year into early 2017. So the question mark is, how aggressive is the Bank of England to negate that? Because obviously any action that you take takes several months for it to then feed through into the system. But the thing that we've seen in the last week or so is you've had the Fed kind of kick the can down the road, similar from Draghi, and the Bank of Japan, if anything, delivered more of a fiscal than a monetary stimulus last Friday. So rather than being outright dovish, they've been just moderately dovish, I'd say. So there is a big question mark here on how much does he ease. I think the premise of QE is too early at this point. However, I do believe that will come later this year. But I think Mark Carney's best tactic here is probably just to deliver a cut and just that, and then review later on once more Brexit data is known and other central banks' policies start to take more action with expected ECB QE tweaks to come in September. But we'll look at that more closely when that time comes. But that'll be Thursday. That'll be a big event for cable. Looking top left here at sterling. Obviously, this is the big move from 150, those year-to-date highs, just as when the polling booth closed on June 23rd. Then the shock result, the surge lower. The overall print on the downside, low of 128.06 is the post-Brexit low. And then since that time, we've kind of been fairly mid-range from 128 to 135. Now, I don't really see that breaking until we get that Thursday decision. And depending on what he does, we're trading at 132.50. I think a cut alone, I think 130 maybe still looks pretty sensible to hold at this point. But if he decides to be a bit more aggressive with a cut and maybe liquidity, further provisions, or if he goes as far as QE as well this early in the game, which I don't think is priced in, then certainly that 128 could be viewed again. On the other side of the coin, should he not cut rates and delay again, which I would say is also a possibility, then certainly that 135 I'd expect to be tested, but that's been a pretty firm resistance level thus far. Okay, finally, a quick look ahead for the week. So we've already seen the various European manufacturing PMIs come out. As I've been speaking, you just had the German manufacturing PMI come in, 53.8. That's broadly in line with expectations, 53.7. So no great surprises there. The French number was indeed in line. You've got the ISM manufacturing from the US. Keep an eye on that this afternoon. That's at 3 p.m. Otherwise, as we go through the week, you've got the RBA interest rate decision. That'll be overnight this evening. So when we come in tomorrow morning, we'll know the result of that. You've got your API crude oil inventories as usual Tuesday, DOEs to follow on Wednesday. You've got around 115 S&P 500 companies reporting this week, so quite a lot, but most of the big names are now done already. The bigger ones you're looking out for are Procter & Gamble and Pfizer. They're reporting this week. And from a European perspective, BMW, HSBC, Rio Tinto, Siemens, RBS and Allianz report through the week. So certainly earnings pre-market still to be keep half an eye on to dictate possibly some of the futures price action if you're trading Euro stocks and DAX. Otherwise, Wednesday could be interesting, especially from a UK point of view for the service PMI. Obviously, the service sector closely in focus given the high proportion that contributes to the country's GDP. And then you get the various job indicators, ADP employment. You've got the ISM today, the non-manufacturing ISM later in the week. Obviously, everyone looking at the job components. This then leads us into Friday with the US non-farm payroll number. Now, US non-farm payrolls, briefly, that'll be very interesting to see. The kind of 3-month trailing average, if you like, is still tracking well below the kind of comfortable Fed level, I'd say. I think it's more like 140 to 150,000. The Fed obviously more comfortable with an average job creation headline of around 200,000. And this obviously accounts for the wild volatility we've had the last 2 months, ranging from 11,000 to 287,000. So it's going to be interesting from a more data consistency point of view, and whether the job situation in the US is truly as strong as last month indicated. So that's going to be coming up on Friday. So quite a busy week overall, quite a bit of data coming out, but I must stress we are now in August. And so this is the summer trading month where volumes, liquidity tends to die down quite a bit. Most major traders tend to take a back seat, and that coinciding with a lot of central banks kind of shutting down shops, but so to speak. Remember, there's no ECB meeting in August, and generally speaking, the ECB members tend to not speak at all over the month. So a lack of communication from the main drivers of the market, the central banks, then it does mean that things tend to get very quiet during August. Coupled that, you have the Olympic Games in Rio. That starts on Friday, so thereafter as well, that sometimes adds to a lack of volume. This can, though, I must say, a word of warning, add to some quite erratic price movement. I think you've already seen that a couple of times last week where the correlations break down. And that is because really a lack of participation in the market, so just to be aware of. Okay, so that's your morning briefing. Hope you've had a good weekend, you're refreshed and ready to go. As I say, quite a few things to look out for this week. Earnings, you've got the Bank of England Thursday, non-farms on Friday. So good luck and enjoy your trading day. Thank you.